So, what happened in Greece, and why did it happen? The entry of Greece into the Eurozone in 2001 was widely expected to mark a transformation in the country's economic performance, which during the 1980s and 90s had been mired in double-digit inflation rates, anemic real growth rates, large fiscal and external imbalances, and a series of exchange rate crises. Adoption of the euro was expected to produce a low inflation, low interest rate environment conducive to economic growth. And that's precisely what happened, at least for a while. From 2001 until 2008, inflation averaged in the low single digits, and real growth at almost 4% a year was the second highest in the Eurozone. And interest rates, well, they came tumbling down. The spread between 10-year Greek and German sovereigns fell from over 600 basis points in the late 1990s to between 10 and 30 basis points after Greece joined the euro. Greece had found the magic formula for economic success, or so it seemed. But beneath the surface, deep-seated problems were left unaddressed. Economic growth was being underpinned by an expanding government sector, and related to that situation, the country was uncompetitive internationally. Here are just a few examples from the period 2001, the year in which Greece joined the Eurozone, until 2009, the year in which the Greek financial crisis erupted. Fiscal deficits consistently topped 5% of GDP, peaking at around 15.5% at the end of the period. The widening of the fiscal deficits was mainly expenditure-driven. The share of government spending in GDP rose by about 9 percentage points to 54%, mainly during a period that featured a government run by a conservative party. Competitiveness was a major problem. Greece joined the Eurozone with a current account deficit that was huge, 11% of GDP. By the end of the period, it had swollen to 18% of GDP. The widening of the fiscal deficits was mainly due to the behavior of the public sector. Net public saving as a percent of GDP dropped by 10 percentage points during the period. Despite these large and growing imbalances, interest rate spreads on Greek sovereigns remained at low levels until the fall of 2009. At that time, financial markets abruptly began focusing on Greece, and spreads began an upward climb. By May 2010, 10-year spreads had reached 1,000 basis points. Despite an adjustment program with the IMF and Greece's Eurozone's partners, spreads continued to climb, reaching 4,000 basis points early this year as the Greek government agreed to a second adjustment program with official lenders and restructured its debt. Since 2009, real GDP has dropped by more than 20%. It's projected to fall by another 6% this year and another 4%, perhaps 4.5% next year. The unemployment rate has risen from under 8% to 25%, and it continues to rise. These are Great Depression numbers at its worst. A question that arises is how a country that entered Europe's monetary union with a huge external deficit was able to function for many years without adjusting. To answer that question, let's go back to see why what happened to Greece would likely not have occurred under the classical gold standard. What was the gold standard? Essentially, it was a regime under which the authorities of the participating countries pegged the prices of the currencies against gold and therefore against each other by buying and selling gold on demand at those fixed prices. In other words, national currencies were fully convertible into gold. The gold standard in its most pure form prevailed from the period from 1880 to 1913. Compared with subsequent monetary regimes, such as the gold exchange standard of the 1920s and 30s, under which the US dollar and the pound sterling were used interchangeably with gold, the Bretton Woods regime that began in the 1940s, and the present managed floating regime, its performance in terms of the stability of real economic variables was mixed at best. nevertheless, it proved to be remarkably durable, with virtually no instances of major runs against any of the leading currencies. What accounted for its durability? Under the gold standard, an adjustment mechanism worked as follows. Countries with external deficits, such as Greece under the euro, would typically experience outflows of gold reserves, and with money and credit tied to gold, lower money and credit growth rates, which reduce prices and wages, and which improve competitiveness, thereby eliminating or helping to eliminate external deficits. Table 1 presents data on fiscal and external positions of some European countries during the gold standard period. All of the countries except for Greece were members of the gold standard for most of the period. Several points are important to notice. First, fiscal positions, in most cases, were close to balance. Second, in most cases, the share of government spending was below 10% of GDP, compared with about 50% for many Eurozone countries today. Third, some gold standard countries ran perpetual current account deficits, but the size of the deficits were small, below 3% of GDP, because fiscal deficits were very small, and the adjustment mechanism, while imperfect, nevertheless worked to mitigate the buildup of large imbalances. Fourth, the major exception is the case of Greece, which in an effort to build its infrastructure following centuries of foreign occupation, consistently ran large fiscal and external deficits. It's no coincidence, therefore, that Greece, in contrast to the members of the Gold Standard Club, suffered a series of foreign exchange and sovereign debt crises during the Gold Standard period. Now let's take a look at the adjustment mechanism in the Eurozone. Table 2 presents average growth rates of money, or M3, and domestic credit for Greece, Germany, and the Eurozone as a whole during the period 2001 to 2009. Notice that money and credit growth grew at considerably higher rates in Greece, a country with a large external deficit during the period, than in Germany, a country with a large external surplus, or the Eurozone as a whole, which had essentially balanced external positions. What's particularly striking is the much faster credit growth of the private sector in Greece, at around 16.5% a year, than in Germany, at around 2.5% a year. In other words, money and credit flowed in the opposite direction of that needed to bring about external adjustment. A consequence of these flows is shown in Figure 2, which presents real exchange rates for Greece and Germany during 2001 to 2009. Greece's real exchange rate appreciated by about 15% against that of Germany, meaning that since the countries share the same currency, inflation was higher in Greece than in Germany. The opposite of what was needed to bring about external adjustment, the opposite of what would have happened under the gold standard, but entirely consistent with the relative flows of money and credit in the two countries. Why is this circumstance important? Because we often hear that the Eurozone lacks sufficient wage and price flexibility to function as an optimum currency union. That may or may not be true. But my point is, even if there had been perfect wage and price flexibility, the flows of money and credit that occurred acted to exacerbate rather than correct external imbalances. In other words, Bob Mundel's famous argument, which helped him earn the Nobel Prize in economics, that an optimum currency union requires wage and price flexibility, turns out not to be a sufficient condition for optimality. What caused money and credit to grow at high rates in Greece? The data on Greek sovereign debt in Table 3 provides some surprising answers. Several points are important to notice. First, foreign money poured into Greece and financed all of the increase in Greek sovereign debt. While the stock of sovereign debt doubled from 2001 to 2009, the share held by Greek residents dropped from 56% to 21%, while the share held by non-residents jumped from 43% to 79%. Second, Greek banks were large net sellers of Greek sovereigns. They used the proceeds to lend to the private sector, which is why credit growth of the private sector surged. Now, I've argued that the adjustment mechanism under the gold standard was self-correcting, while the adjustment mechanism in the Eurozone was self-perpetuating. What accounts for this critical difference between the two regimes? Figure 3 points to an answer. It shows spreads relative to the UK, the gold standard center country, of some European gold standard peripheral countries along with Greece. Typically, spreads under the gold standard were pretty large, in the range of 50 to 400 basis points, despite the small imbalances of the participating countries. The case of Greece is the exception that proves the rule. It was not a member of the gold standard club, and its spreads were way above those of other European countries because it had by far the largest imbalances. Why were spreads so high under the gold standard but so low in the Eurozone prior to the eruption of the Greek crisis? The answer has to do with sovereign credit risk. Under the gold standard, the knowledge that sovereign risk and therefore spreads would rise if imbalances rose acted as an automatic brake on the buildup of imbalances. In turn, low imbalances underpin the durability of the system. In the Eurozone, the market's perception that Greek sovereigns represented a safe investment, probably founded on the expectation of a bailout by core countries, suppressed the effect of sovereign credit risk on Greek interest rates. In turn, low Greek interest rates greased the wheels of fiscal expansion by sending a message to the Greek politicians that there'd be no price to be paid for the buildup of sovereign debt. Does this mean that we should go back to a gold standard? Not necessarily. As I mentioned, real economic performance was less than satisfactory under the gold standard, and it subjected domestic price developments to the vagaries of gold discoveries. Nevertheless, for its European members, it proved to be durable and free from crises because in the absence of perceived bailouts, interest rates bore credit risks so that fiscal and external imbalances were contained. I'll conclude with the following remarks. First, the lesson from the gold standard for today is pretty striking. Adherence to a hard peg can only be sustained in the presence of credible fiscal policies. Second, as the Eurozone emerges from its crisis, the market's perception of sovereign credit risk is likely to recede, at least over time. As it does, fiscal discipline will need to be applied seriously this time in the Eurozone to allow the adjustment mechanism to work and to ensure the viability of the system. Thank you.